Here's something most people already know. Once you reach a certain age, the IRS requires you to start withdrawing money from your retirement accounts. What's less understood is that the age itself depends on when you were born, that the first year works differently than every year after it, that there's a real cost to missing one, and that there are two distinct ways to reduce the size of that withdrawal years before it is ever required. I'm Josh Duncan, partner at F5 Financial Planning, where we take a fiduciary approach to maximizing our clients' wealth. Today, I want to walk you through required minimum distributions, or RMDs, from start to finish. You'll learn exactly when yours begins, how the first year works differently, what happens if you miss one, and two strategies to let you get ahead of the whole problem before it ever shows up. A required minimum distribution is the amount the government requires you to withdraw every year from accounts like a traditional IRA, a 401k, or a 403b once you reach a certain age. You don't get to leave the money in the account and let it keep growing tax deferred forever. The whole point is those accounts were there to let you delay tax, not avoid it permanently, and at some point, the IRS wants its share. So it requires withdrawals whether you need the income or not. For years, the RMD age was 72. With the passing of the Secure 2.0 Act, the RMD age depends on the year you were born. If you were born in 1950 or before, your RMDs began the year you turned 72. If you were born between 1951 and 1959, your required beginning age is 73. If you were born in 1960 or later, your required beginning age is 75. Picture two brothers, 2 years apart. One was born in 1959, so his RMDs began at age 73. His younger brother was born in 1960, so his RMDs don't begin until 75. Same family, same kind of accounts, two entirely different starting lines simply because of a 2-year gap in birth year. If you've been carrying around a number in your head from an article you read a few years back, it's worth checking that number against your actual birth year today. There's one more detail worth knowing if you're still working. If your RMD would come from a current employer's retirement plan rather than an IRA, and that plan allows it, you may be able to delay your RMD from that specific account until the year you actually retire, as long as you don't own 5% or more of that business. That exception applies only to the plan at the employer where you're still working. It does not apply to IRAs, including SEP and simple IRAs, or to old employer plans left behind at previous jobs. So it doesn't cover every account you own just because you're still on someone's payroll. One more important piece, this rule applies to traditional IRAs, SEP IRAs, simple IRAs, and most employer retirement plans. It does not apply to Roth IRAs during your lifetime. If you've been building a Roth IRA, that money can sit and grow for as long as you're alive with no forced withdrawal at all, which is exactly why so many people work to move money into those before RMDs ever start. We'll come back to that in a few minutes. Your birth year is what determines your required beginning age, not a single number that applies to everyone the same way. Once you reach your applicable age, every year after the first year works the same way. You take your withdrawal on the schedule. The first year is the exception, and it works differently than most people expect. The rule gives you an unusual amount of flexibility in year one. Instead of requiring your first RMD by December 31st of the year you reach your applicable age, the IRS allows you to delay it until April 1st the following year. On paper, that sounds like a straightforward benefit. Extra time, extra flexibility. Why wouldn't you take it? Here's the detail that matters. If you delay that first withdrawal into the following year, you still owe your second RMD by December 31st of that same year, which means you could end up taking two full distributions in one calendar year, both landing on the same tax return, both stacking on top of each other. So imagine a retiree who turns 73 this year and decides to wait since April sounds more comfortable than December. Come next spring, that first RMD gets withdrawn, but the same year's own RMD, the second one, is still due by the following December 31st. Two distributions, one tax return, one much larger number showing up as income than either withdrawal would have created on its own. This isn't just a technicality. Two RMDs landing in one tax year can push you into a higher tax bracket, and it can also increase your Medicare premiums 2 years later since those premiums are based on the income you report today. A decision that felt like extra flexibility in the moment ends up creating a larger tax bill than either withdrawal would have created alone. The delay option is not automatically the right move. For most people, taking that first RMD in the same calendar year you reach your applicable age rather than pushing it into the following spring keeps your income spread out and your tax bill more predictable. There are cases where delaying makes sense, usually tied to a specific known drop in income expected the following year. But that should be a deliberate decision made with your planner, not a default one. Now, let's talk about what happens if an RMD gets missed entirely or if you withdraw less than required. This penalty used to be steep, 50% of whatever you fail to withdraw. That's been reduced, but it's still meaningful. Today, if you miss the full amount of your RMD, the IRS can charge an excise tax of 25% on the shortfall. If you catch the mistake and correct it within 2 years, that tax drops to 10%. Here's what that looks like in practice. Imagine someone who was supposed to withdraw a certain amount for the year and simply forgot, maybe because they changed custodians, consolidated accounts, or a new advisor didn't have the account flagged properly. Whatever amount they should have taken and didn't, the IRS can take a quarter of it on top of the ordinary income tax still owed once the distribution is actually taken. On a meaningful shortfall, that adds up, and it's the kind of mistake that's avoidable with a little bit of tracking. This penalty isn't automatic or final. If the shortfall happened because of a reasonable error and you're taking real steps to fix it, there's a process to request that the penalty be waived. It involves filling out a specific form, Form 5329, with your tax return and attaching a letter explaining what happened and how it's being corrected. This exists because mistakes happen, especially when someone has multiple accounts spread across multiple institutions, each with its own calculation, its own paperwork, and no single custodian keeping track of the full picture on your behalf. Missing an RMD is a real financial cost, not just paperwork, though it's also fixable if you catch it and correct it quickly. The moment you suspect one was missed, deal with it directly rather than waiting. Okay, so far we've talked about rules for handling an RMD once it exists. Now let's talk about something more useful, reducing the size of that RMD before it becomes a factor at all. There are two main tools for this, and they serve two different goals. The first is the Roth conversion. A Roth conversion means moving money out of your traditional IRA, paying the income tax on it now, and placing it into a Roth IRA where it can grow tax-free with no future RMD attached. The years between retirement and your applicable RMD age are often the best window for this because your income may be lower than it was while you were working, which means the conversion can happen at a lower tax rate than you might pay later. Every dollar you convert during those years is a dollar permanently removed from the balance your future RMD will be calculated against, which means smaller required withdrawals, smaller tax bills, and less risk of the bracket jumping issue we just covered. I walked through the full mechanics of this, including when it makes sense and when it doesn't, in a previous video on Roth conversions, so I won't repeat all of that here. In the context of RMDs, the goal is simple. Every dollar you convert now is a dollar that will never generate a required distribution later. The second tool is the Qualified Charitable Distribution, or QCD. If you're charitably inclined, this is one of the most efficient moves available. Starting at age 70 and a half, a few years before the earliest possible RMD age, you can send money directly from your IRA to a qualified charity. Once your RMDs begin, that same QCD counts towards satisfying the requirement, but it is never included in your taxable income at all. There is an annual limit on how much can be sent this way, adjusted periodically for inflation, so check the current figure with your custodian or your advisor rather than assuming last year's number still applies. Compare a QCD to writing a check to the same charity from your bank account. In that case, you'd still owe tax on the full RMD, and you'd only get a deduction for the donation if you itemize, which fewer people do now that the standard deduction is so much higher. With a QCD, the tax question disappears entirely for that portion of the withdrawal, whether or not you itemize. Picture two retirees, each with the same RMD, each getting the same amount to their church or favorite charity every year. One writes a personal check after taking the full RMD into their bank account. The other directs that same amount straight from the IRA as a QCD. Both gave the same amount to the same cause, only one of them paid tax on the money. that was headed to charity anyway. These two tools solve different problems. A Roth conversion is about long-term tax bracket management done in advance. A QCD is about the giving you're already doing redirected to be more tax efficient the moment RMDs begin. Many people benefit from using both in different years and for different reasons, and using one doesn't require giving up the other. Now, the single biggest mistake I see with RMDs isn't a bad decision, it's no decision. People treat the whole topic as something to figure out the year it finally applies to them instead of something to plan around years in advance. Here's a simple habit that solves most of this. Every December 31st, take stock of every account that will eventually be subject to an RMD. Not just one IRA, but every IRA. Every old 401k sitting with a former employer. Everything, including your spouse's accounts if you're married, since each of you has your own applicable age and your own separate calculation. Each of those balances feeds into the total once RMDs begin, and a lot of people underestimate how large the combined distributions turn out to be simply because they never added the accounts together in their head. From there, treat Roth conversions and QCDs as an ongoing decision reviewed every year rather than a one-time choice made after the first RMD notice already shows up. Are you in a lower income year that makes a conversion attractive? Are you already planning charitable gifts for a year that can be redirected as a QCD instead? These aren't decisions to make once, they're decisions to revisit annually, the same way you'd revisit your investment allocation or your household budget. Ideally, with your financial planner and tax preparer in the same conversation, well before December, rather than after the year has already closed and the options with it. It's also worth glancing at your beneficiary designations during the same annual review, since the accounts subject to RMDs today are the same accounts your heirs will eventually inherit. RMDs reward people who plan ahead and cost people who wait. Treat this as a recurring part of your financial life, reviewed every year well before your applicable age arrives, and it becomes just another line item you've already accounted for, rather than something that shows up unannounced. All right, let's bring this together. Your RMD age depends on your birth year. 73 if you were born between 1951 and 1959, 75 if you were born in 1960 or later. The first year works differently than every year after, and it often creates more tax problems than it solves if you delay. Missing an RMD carries a real cost, though one that can be fixed if you act quickly and file the right form. And you have two genuine tools: Roth conversions and qualified charitable distributions to shrink the size of the problem long before it ever arrives, whether your priority is managing your tax bracket, supporting the causes you care about, or both at once. None of this replaces a conversation with your own financial planner and tax professional, since the right mix of these strategies depends entirely on your specific accounts, your income, and your goals. But now you know the questions to bring to that conversation well ahead of the year you're actually needing the answers. Thanks for joining me today. If you would like to learn more about how F5 Financial Planning helps our clients achieve financial freedom for personal significance, please visit our website at www.f5fp.com.